All right, guys, coming to the end. This is the last chapter I need to do lectures for. Can't say that I'm sad to see it ending. Anyway, this last bit of videos relates to the analysis of financial statements. Frankly, it's actually pretty interesting stuff, so it's nice that we're ending on a good note. And essentially, we want to make some high level interpretations from the financial statements. Like, how do we read them? How do I identify issues with them? Are there glaring red flags within a company that we see in the financial statements? Are there things that the company does really well that we're seeing in the financial statements? This chapter, we're going to sort of address some of the high level stuff associated with identifying those issues. All right, so in this lecture, I'm going to define the building blocks of the analysis. Like, what do we look at? What are the financial statements we look at? Who uses them? What are the broad categories of things we're going to analyze? And then we're going to go through essentially 3 lectures after that, at a minimum, maybe. So we're going to do what we call a horizontal analysis. It'll make more sense in a later video. We're going to then do vertical analysis of the financial statements, and then we're going to do ratio analyses. And I'm probably not going to do a lot on the ratio side, but I will just sort of scroll through some of the calculations for us. Okay? So the building blocks of financial analysis, okay? Um, at the end of the day, we really want to compare our financial statements to benchmarks. That's usually the best way to analyze something, right? So something is valuable relative to something else. That's I would say that's like the, I don't know, high level takeaway or title of this lecture. Okay, so common goal financial statement analysis for both external and internal users is to evaluate the company performance and financial condition, right? We're going to look at the past results and we're going to look at the current performance. We might even look at future anticipated expectations. We're going to look at the financial position of the business. And then, like I said, we're obviously going to want to know what the outlook is, right? So anything valuable, it definitely has a lot to do with what we've done and what we currently are doing. But for the most part, a company's value is really derived from what it's anticipated to do. Okay. That again is a corporate finance issue that you will learn in those corporate finance classes. But it has a lot to do with time value of money and anticipated profits and so forth. Okay, so we have internal users, managers, officers, internal auditors. They want to make or reach some preliminary conclusions about the business by looking at the financial statements. And then we have external users, the shareholders, stock owners, lenders, suppliers, right? A supplier isn't going to extend us credit if we are having a difficult time meeting our short-term obligations. So suppliers, big suppliers, may ask to see the financial statements so that it can interpret our financial well-being itself rather than relying kind of on our word. Okay, so the building blocks of the analysis, we have liquidity and can I draw? Can I draw? I think I can't yet. Come on, man. I don't even think I really need to draw. I guess I don't. Hey, there we go. Liquidity and efficiency. So that is the short term. How effective are we at meeting our short term obligations? Are we making the accounts payable when they become due? Right? There are things that we can look at that address liquidity and efficiency. Then we have solvency. And solvency is, are we going to be able to, over the long run or long term, pay off our debts and obligations? Okay. Do our total liabilities exceed our total assets? If they do, we are what we call insolvent. All right. And then obviously we're going to look at profitability. There's all sorts of different types of matrices when it comes to profitability. We could be looking at gross profit. We could be looking at net income. We could be looking at EBITDA, which is earnings before interest, depreciation, and taxes, which is very common in valuation. And then we're going to look at market prospects, right? And again, that gets to what are the future, or what does the future entail for us? We are going to look at income statements, balance sheets, and statement of cash flows. My sense is that this, and this are the three primary financial statements. If we see some red flags, right, we might want to go into the notes to the financial statements and see what the discussions are. How is management describing some of the things that we might find interesting, either things of concern or things of interest and great value, right? The management of the firm are going to have things to say about those issues in the notes to the financial statements. And then sometimes we will look at the statement of stockholders' equity, but that isn't a huge comparison or a huge part of the analysis, in my personal opinion. Okay, so you look at the financial statements for a business, and by themselves, they do yield some value. But what we really want to do is we want to compare our results to our competitors, right? Or maybe we want to compare the results of one of the divisions within our firm to the results of a different division within our firm. But comparability is really, really important, right? So we could be operating at, say, a 20% EBITDA. In fact, let's even make it easier. We could be operating at a 20% net income, meaning our net income is 20% of our revenue. And that sounds really interesting, or sounds really good. But if our competitors are operating at a 28%, or if their net income is 28% of their revenue, and we're only at 20%, then maybe there's something to be concerned about, right? So if we aren't as competitive as some of our closest competitors, that could be an issue, okay? There could be industry guidelines, right? There could be all sorts of different things that we would compare ourselves to, but we call that benchmarking, right? How do we compare to something else that is sort of the benchmark or the standard that we are trying to achieve? The way that we're going to do that, we're going to do that three ways, okay? And again, I think I alluded to these. We are going to talk about horizontal analysis, and that is how we are doing over time, right? My net income in 2024 compared to my net income in 2025. Vertical analysis is what we were just talking about. It's more, in a sense, like comparing the bottom line of the income statement to the top line of the income statement, right? So I'm going to compare net income to revenue, right? In the example I was just using, I was saying we have a 20% net income, right? And that's interesting and it's important because what if I'm looking at two companies that are very dissimilar in size? One is massive and the other one is like, it's big, but it's not nearly as big, right? So if I just looked at raw net income, I would obviously be saying the bigger company is more attractive. However, if I do a vertical analysis of both companies and I say, one company is operating at 20% of revenue and the other company is operating at 28% of revenue, I can more easily compare a big company to a small company. Okay. So that's what vertical analysis is. That will be another lecture. And then we have ratio analyses, which are all sorts of different metrics that we calculate using financial metrics of the financial statements. And that is essentially the overview of financial analysis.